Let's get our business editor Ross Greenwood here. Ross, what are economists expecting for GDP?
They're expecting for the December quarter a slowing in Australia's economy, Tom, but certainly no sign of recession, even though the annual growth rate is expected to come in at 2.7%, and that compares with the previous period where the annual economic growth was 5.9%. There's going to be potentially even a small uptick from the previous quarter, which had been 0.6%, ticking up to 0.8%. This comes as a result of the imports and exports. We've just got the numbers dropping right now. So it's come in at 0.5%, so less than what the market had anticipated. So Australia's economic growth softer than anticipated, and also the economic growth for the year came in at 2.7%. So that annual economic growth rate of 2.7% is lower than the previous annual growth rate of the September quarter, which had been 5.9%. Now, the important aspect of this that we'll be looking at as we go through some of these numbers is just to look at just the way in which the Australian consumer is behaving, with the higher interest rates having kicked in by December last year, just how that affected their spending. We could see that there had been a slowdown in some of the spending, but also then in the broad economic impact of rising energy prices. And so this is the key right now to have a look at this. Now, one of the things that we can start to see is that household consumption during this period of time, according to these numbers, in fact started to moderate. They're saying was 0.3% and effectively had been the weakest quarterly rise in consumer spending since the COVID lockdowns in September 2021. So that's one key to be taken out of this. The second thing is that Australia still is not on track for recession, according to these numbers now. But you can see a genuine slowing, and even the Reserve Bank, Treasury are modelling that Australia's economy could be growing at an annual rate of less than 1% by the end of this year. So you can see here just the way in which our GDP has started to slow over this period of time, and the way in which it's looking right now. But as I say, this latest number coming in as it has, sitting there at 0.5% in that December quarter, is pretty much key to what we're seeing right now, Tom.
Yeah, so just briefly, as the Reserve Bank weighs this up, their main priority is inflation, but they want to avoid recession where possible. So this will just give them a little bit of pause for thought after the retail figures on whether they go for possibly just another 2.5 rather than 0.5, for example.
Oh, they did definitely go for 0.25. I think they've really nailed their colours to the mast in that regard. But the question is, how many more rate rises? Many in the marketplace, the bank economists think there's at least another 3 rate rises to come, which would take the cash rate from its current 3.35% out to around 4.15%. Some say they could go even further, out towards 4.4%. But the issue is that people need to expect that there are more rate rises. But you can see here this quarterly sort of choppy, sort of, if you like, growth in these GDP numbers as they go through really do give you a sense as to what's happened during this COVID period. You've had, like, the September quarter last year or the year before that was pretty poor, but then you come off very strong periods of growth during this. The one I'm actually going to try and find for you is just the household savings ratio, because that one is going to give us a pretty good view as to just what's happened in terms of people's savings. So the household savings ratio here has fallen for the 5th consecutive quarter. Now, the important aspect of this is it's fallen from 7.1 to 4.5%. Now, just to explain this, many Australians right now, if they've got a rising cost of living, yep, they've got jobs, but they can afford the higher energy prices, the higher interest rates, because they can dip into their savings, because post-COVID there was a lot of savings in Australia. They're now being absorbed by the inflation rates, by the higher interest rates, by the higher energy prices. And so as a result, people are still consuming, but what they're doing is that they're starting to increasingly use their savings for that. The real difference between Australia and the United States is really that in the United States, about 6 months ahead of us economically, they have started to use up those savings, and that's the reason why some of the price rises there are starting to bite significantly into demand. We haven't got to that point yet, but that is expected to occur sometime later this year.
Ross, thank you.